Today, the market seems to be shifting in silence. Powell's final address felt like the closing of a heavy chapter, signaling the end of one era for the Federal Reserve. Yet, while the old cycle has not entirely faded, a new one is quietly taking root in the shadows. At the same time, the spotlight on Wall Street has swung towards two familiar figures, Elon Musk and Mark Zuckerberg. One embodies bluster and rockets, the other, an unyielding obsession with data and algorithms. Their clash has never been a mere private quarrel, but rather a distilled reflection of capital and technology locked in rivalry. And so the question arises, will the future of U.S. equities be steered by the invisible hand of policy, or reshaped by the duel between these two iron-willed titans? Life is like a seesaw. Where there is an ascent, there must also be a descent. But on Wall Street, this seesaw bears trillions of dollars in wagers, where the slightest tilt may unleash waves of turmoil. I am Quang Dang, both your reporters in pursuit of the market's truths, and your guide through the fog of finance. Now, let us uncover this story where macroeconomics and technology are inextricably entwined. First, let us turn to Powell's final speech. Its tone was strikingly calm, yet quietly profound. He made it plain that the U.S. economy remains steady, with growth still showing resilience. Inflation, though not yet fully subdued, is gradually being brought back under control. Most significantly, he offered a subtle signal: the Federal Reserve's tightening cycle is nearing its end. This is not merely a policy adjustment. It is the toll of a muffled bell. It marks the transition from years of relentless rate hikes to a new phase of watchful patience and gradual easing. In other words, the taut string of recent years is beginning, at last, to loosen. Naturally, the markets reacted. In the short term, rates appear to have peaked. Financing conditions are improving, and liquidity is seeping back into the system. As Londoners often say, every cloud has a silver lining, and that silver light is now reaching the trading halls of Wall Street. From a longer-term perspective, the direction of capital seems almost self-evident. The closing of the tightening cycle means funds will once again chase high-growth sectors, with technology at the forefront, be it artificial intelligence or clean energy. These arenas are fast becoming the market's hot potatoes, scalding to hold, yet eagerly grasped by all. In short, the pivot of policy and the rise of technology will weave together into a new score for the markets ahead. For investors, the task is not to guess the next note, but to remain calm and learn to hear the rhythm. This week, the U.S. equity market unfolded like a brooding play. After 4 days of steady decline, Powell's Friday remarks struck like a flash of lightning in the night, igniting a strong rebound. By the week's close, the S&P 500 managed a narrow gain of 0.25%. The Nasdaq slipped 0.58%. The Dow Jones rose a steady 1.53%, and the Russell 2000 raced ahead with a surge of 3.36%. Sector performance told its own tale. Real estate led the pack with a rise of 2.74%. Energy and materials followed, up to 0.51% and 2.19% respectively. Healthcare, financials, industrials, and consumer discretionary all gained between 1.7% and 2%. Consumer staples and utilities added a modest 0.5%. By contrast, information technology fell 1.16%, while communications services declined 0.65%. In other words, technology retreated, and rate-sensitive sectors seized the moment. Turning to rates, the market's direction shifted abruptly after Friday. The 10-year Treasury yield plunged 1.32 percentage points to 4.26%. The 2-year dropped even more sharply, down 1.44 points to 3.71%. In oil, WTI crude rose 1.54%, closing at $63.77 a barrel, while Brent climbed 3.67% to $30.6. The dollar index slipped back to 97.73. In digital assets, Bitcoin fell to 0.94%, unable to hold the $116.700 marks, while Ethereum jumped 7.74%, closing at $4.808.73. Gold gained 1.4%, finishing at $3.371 per ounce. At the heart of it all was one name, Powell. At Jackson Hole, he lowered his hawkish stance and turned dovish, stressing that the balance of economic risks is shifting. He signaled that weakness in employment could justify policy adjustments, while downplaying the inflationary threat of tariffs. Markets turned the page at once. Expectations for a rate cut soared from 70% to above 90%. On Friday, all three major indices rebounded in unison, with gold and Bitcoin recovering too. As the saying goes, however thick the clouds, the sunlight will break through. On the company front, Zoom surged 12.7% on the back of strong enterprise performance. Google and Meta rose 3.2% after striking a cloud services deal worth tens of billions. Yet rumors of a production halt for the A720 chip put the AI supply chain under scrutiny once again. Enterprise software maker Workday came under pressure after weak guidance. In retail, fortunes diverged sharply. Ross Stores and TJX displayed resilience, but BGS House slumped 8.5% on disappointing sales. On Friday, consumer discretionary jumped more than 3%, leading all sectors, while consumer staples became the only decliners. The message was clear. Risk appetite has surged in just a matter of days. Looking ahead, next week brings a wealth of macroeconomic data. On Monday, we'll get new home sales figures. On Tuesday, durable goods orders and consumer confidence. Wednesday features oil inventories. Thursday brings second quarter GDP data and jobless claims. And on Friday, we'll see the key reports, core PCE and the Chicago PMI. On the earnings front, look out for reports from Pinduoduo, Nvidia, HP, Alibaba, Best Buy, Dell, Marvell, and Affirm, all of which are likely to move the markets. This week has felt a bit like a performance for days under uncertain skies. And only on Friday did we get a glimpse of clearer conditions in the financial markets. It's important to remember that no one can manage your wealth for you. The responsibility lies with you alone. I'll be breaking down the latest market events to make the complexities of finance easy to understand. Be sure to subscribe so you don't miss out on any potential opportunities to grow your wealth. Let me know in the comments. Do you think tech stocks are ready to rebound from their recent lows? Or do you expect them to continue their downward trend? Remember, silence can often lead to missed opportunities, while those who engage, learning, and taking action may find themselves ahead when new market trends emerge. In Silicon Valley, the drama often rivals fiction. Right now, Musk and Zuckerberg are embroiled in a high-profile rivalry surrounding the Swaz and X platforms. Their public clash has generated a lot of attention, with the two tech giants appearing to be fierce competitors. However, court filings have revealed a surprising twist. Musk previously proposed a joint acquisition of OpenAI, valuing the company at a staggering $97.4 billion. A move aimed at securing a piece of the growing AI market. The situation is truly intriguing. Seemingly public enemies may actually be considering collaboration in the face of a greater prize. It's a reminder that business decisions are often driven by long-term strategies rather than personal conflicts. Another interesting detail from the filings, Zuckerberg has been willing to offer paid packages over $100 million to attract top AI talent from competitors like OpenAI and Google. This demonstrates his commitment to dominating the AI space, and it appears to have motivated Musk to consider a shift in strategy, potentially transforming rivals into partners in pursuit of AI innovation. Faced with overwhelming commercial interests, personal grievances shrink to mere storms in a teacup, dramatic in sound, but trivial in scale. For Musk, this bid carried a deeply personal weight. He is, after all, a co-founder and early backer of OpenAI. Yet in 2018, following disputes over direction, he left the board in frustration, forced to watch as the project drifted from its founding mission of serving humanity and bounds itself ever more tightly to Microsoft, which he denounces as a closed-source machine, a tool for profit. Enraged, he sued OpenAI. The irony is rich. It was this very lawsuit that exposed his clandestine partnership with Zuckerberg. Publicly, Musk casts himself as a guardian of humanity, condemning Sam Altman for betraying the mission. Privately, he was plotting with his arch-rival to seize the company outright. Such contradiction has inevitably drawn ridicule. DeNavis, an analyst at Wedbush Securities, remarked that this is classic Musk power play. He is both destroyer and builder, seeking through acquisition to reclaim what he believes is rightfully his, while also buying precious time for his own venture. XAI in this grand chessboard. Zuckerberg is merely a piece of proof that there are no eternal enemies, only eternal interests. Veteran tech commentator Kara Swisher was blunter still. Musk wraps himself in the garb of an AI savior, claiming to resist the greed of capital, yet plays the same game, if anything, more aggressively. His lawsuit, she argued, is less a sacred mission than a piece of commercial opportunism. Ben Thompson of Strategy offered a wider perspective. Both Musk and Zuckerberg recognized that a standalone AI model company cannot survive in isolation. The true moat lies in data and distribution. Musk has X, Zuckerberg commands Meta's vast social networks. Were they to succeed in swallowing OpenAI, they would not only secure cutting-edge modeling technology, but grafting it onto their own distribution systems, building a super ecosystem capable of countering the Microsoft OpenAI alliance. In short, what appears to be a personal feud is in truth a struggle for power. What looks like a Silicon Valley cage fight is, in reality, a far deadlier game of capital. Tesla's performance today was nothing short of a wake-up call. The stock closed at $341, up a striking 45%. During the session, it reached a high of $341.43 and a low of $319.58. Volatility as dramatic as London's weather, clearing skies one moment, storm clouds the next. Until the 22nd of August, Tesla's share price had been stuck between $320 and $335, like a boat trapped in a teapot, unable to stir up any real waves. But today's breakout was forceful and impossible to ignore, a clear sign of fresh capital flowing rapidly into the stock. And when one speaks of Tesla, one cannot avoid speaking of Elon Musk, both engineer and master of provocation. He knows how to shift market sentiment with a single remark. Recently, he has been pushing the idea of robo-taxi autonomous driving, while positioning his XAI venture as a rival to OpenAI and Meta, playing, once again, the role of tireless disruptors. The market's interpretation is straightforward. Tesla's future is not merely in electric vehicles, but in a network of autonomous mobility, amplified by the imagination of artificial intelligence. Today's surge, in part, reflects a recovery in investor confidence. They are betting that Musk's projects can draw a new wave of capital and drive large-scale adoption. In other words, this rally was not simply an endorsement of Tesla itself, but another vote of confidence in Musk's ability to tell a compelling story. Yet Wall Street is nothing if not ruthless. Today, you may be the bubbles in champagne. Tomorrow, the sediment at the bottom of a beer glass. Turning to Meta, its performance today was steadier, but no less impressive. The stock closed at $754.79, up 12%, trading between $734.94 and $756.71, compared with $739. And on the 21st of August, it marks a clear lift. More importantly, trading volumes climbed sharply, a sign that market sentiment is beginning to tilt towards optimism. Zuckerberg's strategy remains consistent, calm, data-driven, and methodical. He continues to double down on open-source AI, with Llama at its core, blending Meta's vast social datasets and ad engines with artificial intelligence. At the same time, he has not abandoned the metaverse. Instead, he is reattaching it to AI, in the hope of breathing new life into what was once mocked as a money-burning illusion. Today's share price rises, coupled with the spike in trading activity, suggests growing recognition of Meta's medium-term strategy. Investors are beginning to believe that Zuckerberg can not only sustain profits through social advertising, but also open a fresh growth curve by fusing AI with the metaverse. Zooming out, the rivalry between Zuckerberg and Musk resembles a modern-day joust. Musk advocates a closed, tightly integrated models, Tesla, and Shy at the center, technology and capital wielded with an iron grip. Zuckerberg, by contrast, champions an open ecosystem, using the breadth of social networks to amplify influence. Their clash has deep roots, from the early SpaceX satellite incident to philosophical battles over AI, and more recently the platform duel between X and Threads. In this century-defining contest over artificial intelligence, both Musk and Zuckerberg may endure, but in the end, only one is likely to emerge triumphant. The logic of capital is shifting in subtle but unmistakable ways. With interest rates peaking, market liquidity is beginning to return, and no sector stands to benefit more than high-growth technology. Investors are once again placing their bets on the new narrative of artificial intelligence, fused with social platforms and the automotive industry. Federal Reserve Chair Jerome Powell's latest remarks carried hints of a softer policy stance for the market. It was like pouring a bucket of water into a parched pond. Growth-oriented technology stocks immediately drew strength from it. Elon Musk continues down his familiar path of high-frequency innovation, driven by headline-grabbing projects. His vision of robotaxi and autonomous driving is gaining traction again, thanks to a friendlier funding environment as rated pressure eases. His venture, Shy, too, now looks better positioned to attract capital. Musk's style is high volatility, high drama, capable of moving the stock with sudden bursts of energy. Yet his very personality, straddling idealism and realism, is both Tesla's greatest asset and its sharpest risk. As the British saying goes, a sword may cut through the brambles, but it can just as easily wound the hand that holds it. Mark Zuckerberg, by contrast, has chosen the steady path of ecosystem building. Meta's open-source AI models are attracting a growing base of developers, rapidly expanding its reach. Meanwhile, the Metaverse project, once derived as a costly illusion, is regaining market patience and valuation support under looser financial conditions. Unlike Musk, Zuckerberg does not thrive on theatrical bursts. His method is systematic accumulation, shaping long-term value brick by brick. Today's market moves capture this dual recognition. Musk represents speed and elasticity, Zuckerberg, stability and structure. Together, they form the twin engines of the technology sector, reaffirming for investors that AI is no passing fad, but a long campaign powered by the combined forces of capital and technology. In short, with rates peaking and liquidity circling back, growth stocks are poised for revival. Tesla exemplifies explosive upside, Meta embodies steady compounding. Two narratives running side by side. We have created a new dual engine framework for the market. Looking ahead, how will this shift ripple through the wider U.S. market? In the short term, Powell's signal of policy easing has lifted investor confidence. Naturally, leaders such as Tesla and Meta were the first to benefit, while the Nasdaq itself found renewed support. Over the longer horizon, the rivalry and, at times, the convergence between Musk and Zuckerberg will push AI technology into greater diversity. This will, in turn, fuel demand for semiconductors and computing power, bringing companies like NVIDIA, AMD, and Intel are firmly into play.